Ira, as we talked before we came back on air, you're not looking at May 3rd, you're looking at June 14. What does this information say about summer Federal Reserve meetings?
Yeah, I think that the Federal Reserve is probably going to remain cautious. Like, remember, we talk about all the banking angst and what's going on with First Republic and potential credit tightening later in the year. But at the same time, the Federal Reserve is going to be keenly focused on inflation, and you still have some inflationary dynamics here. Obviously, some of the deflators were a bit higher than were expected, but then you go into things like the wage data, and you still see 6+% annualized increases in wages and salaries over the last 3 months. And you say, okay, well, labor still has pricing power. That means the services sector still hasn't rolled over yet in terms of how much businesses are going to have to increase prices. So I think the Fed is still going to be very cautious as to how hard it has to fight against inflation.
So that's what the market's expecting. That's what's priced in. And we could see a peak Fed funds rate of 5.1% priced in come June. And that goes to 4.2% come January of next year. Does this cohere with the resilience that we see? I mean, this is what Lindsay Piegza was saying. No, absolutely not. She still sees the Fed going up to 6%. Can we even know? Where do you sort of stand on this?
Yeah, so it's it's very difficult to have very deep conviction as to exactly where the terminal rate will be. But my view is that the Fed will hike one more time, maybe two, but we're not going to see a 6% handle on any of the Fed funds, any of the Federal Reserve's measures. But I think what they do is they do pre-commit to staying the course and maintaining rates at 5.25%, 5.5% for the rest of the year. And the advantage of that from their standpoint is you wind up pricing out some of those cuts that are currently priced into the market, because the Fed doesn't want to go too far where they cause a much deeper economic slowdown later. So they want to kind of find a sweet spot where they can slow the economy, but at the same time not cause a deep recession and get inflation lower. And the way to do that is to actually pre-commit somehow and say, look, we're only going to cut if the unemployment rate goes up a few percent and inflation is, say, headline inflation on the PCE deflator is below 3%. If they don't want to pre-commit like that, but I think that's what it will take for the market to actually price out some of these cuts that are easing financial conditions when the Fed doesn't want them to be easier.